Okay, so today I'd like to talk to you a bit about Deterra Royalties, an Australian-based company. We are a royalty company. We've been around since late 2020. We were created through a demerger from a mineral sands operator also based in Perth called Iluka Resources. We're listed on the ASX. We have a market capitalisation of about $2.4 billion Australian. And that puts us pretty firmly within the ASX 200. In terms of our assets, as I said, we specialise in royalties over mining operations, and we were created with a small portfolio of 6 royalties, 3 of which are producing. Of those producing royalties, 1 is over an iron ore operation, and I'll talk about that asset at some length in a moment. Another 2 are over mineral sands operations, also based in Western Australia. As a holder of these royalty assets, we offer our investors the benefits of the royalty and streaming model, but importantly, outside of precious metals. We provide scale and we provide that exposure within an Australian context. In addition to our current assets, we're looking to add to the portfolio to bring in some additional sources of earnings growth and diversification. As you can see on the chart here, the pie chart to the left, we have quite a diversified register. Iluka Resources, who was our parent company, has retained a 20% owning, but we have strong institutional support within the ASX. The royalties and streaming business model is obviously very well established with some very successful exponents, and we heard from one of them over lunch. It's a model that is not as well pursued within Australia, but we're looking to pursue that. In terms of how we're going about doing that, we have what we think are some pretty important points of difference. First, we have quality. Our cornerstone asset, the iron ore royalty, which is over Mining Area C, is what we believe to be one of the highest quality royalty assets anywhere globally in any commodity. It provides us with top-line exposure to a world-class iron ore operation. Second, we have scale. In our last full year, we reported revenues of $265 million Australian, which combined with the fixed cost nature of the business enabled us to report EBITDA margins in excess of 95%. Third, we have a record of returning cash to our shareholders. In the just over 2 years since we were listed in November 20, we have returned more than $330 million Australian to our shareholders by way of dividends paid or declared, including the half-year dividend that we declared a couple of weeks ago. We have growth. In the period since listing, we've seen significant volume growth at the Mining Area C royalty following the completion of a $3.6 billion expansion of the mine, which is expected to more than double volume. We also have a focus on value accretive investment, and importantly, we have the liquidity to support it, and I'll come back to that shortly. Finally, ESG is an important element of both our everyday processes and our investment activity. Earlier this month, we released our interim results for the first half of the year of fiscal 23, and I might just touch on those briefly. It was another period of strong performance for the business. In particular, our assets continue to perform well, and we reported revenues of more than $96 million for the half. Revenues were once again driven by the performance of the Mining Area C royalty, which accounted for the vast majority of those revenues. Albeit on a much smaller scale, our other producing royalties also had a strong period, and we saw revenues from Doral's mineral sands operations increase following its move to the Yalyalup mine site last year. We remain well positioned for future growth, both organically, where the ramp-up of Mining Area C expansion is expected to continue until mid-calendar 2024, and inorganically, where we have a clean balance sheet that had a small net cash balance at December 31, and $350 million of credit facilities available to us, which are undrawn and available to us to fund future value accretive investments and transactions. We also declared an interim dividend of 12 cents per share, fully franked for the half. I mentioned our cornerstone asset, the Mining Area C, and that I'd talk to in a little further detail. The mine itself is a core part of one of the best iron ore operations in the world. It's well positioned on both the cost curve, as you can see there. The north and south flank operations are in the first and second quartile from a cost perspective. It's a low emissions intensity producer, and it's on a global scale. To put the scale in context, when the operation meets its full nameplate capacity of 145 million tonnes a year, that will represent approximately 8% of total global seaborne iron ore trade. It's also a very long life mine. It's been producing for over 20 years since it first opened in 2003, and is currently in the process of bringing on that south flank expansion that I mentioned. In the chart on the left side, you can see these additional volumes starting to come in the last three halves, following the completion of construction and beginning of commissioning in May 2021. This has resulted in a significant increase in production from 61 million wet tonnes in FY21 to 111 million wet tonnes in FY22. First half volumes, as you can see on the chart here, were just under 63 million wet tonnes. Importantly, from a growth perspective, there's still substantial volume growth anticipated over the next 12 to 18 months as the operation moves towards the announced nameplate capacity of 145 million tonnes a year. In addition to the expansion, there's further optionality associated with the other deposits that have been identified within the royalty area. On this chart here, you can see the royalty areas outlined in orange. The deposits on the right, the north flank and the south flank, are the existing operations, and they are expected to continue to operate into the mid to late 2040s, according to BHP. There are also deposits identified further west in the royalty area, which you can see in this chart here in the blue and green. Should those be brought onto production at some point in the future, they would be expected to extend the mine life and would generate further royalty revenues for us. Our interest in this operation has two elements. One is a fairly standard revenue royalty, which entitles us to receive 1.232% of the revenue from the mine's operations. And that's a top-line exposure, and importantly, that gives us the protection against cost inflation and capital cost inflation as well, operating and capital cost inflation. The second leg is a capacity payment, which entitles us to receive some one-off payments as the overall capacity of the mine increases. $1 million for every 1 million tonne increase in capacity. If we go back to one of the earlier slides, you can see here on the right we've broken out the payments that were received in grey. The dark grey first half payments, light grey second half payments, but the orange payments you can see there are capacity payments. So as volume is increasing, subject obviously to price that's achieved, we've seen that growth in revenues as well as those one-off payments in orange, particularly in FY22 following that ramp up of production from 61 to 111 million tonnes. I mentioned earlier we're looking actively to grow our business by adding assets to the portfolio. And to do that, we're targeting opportunities outside of the precious metal space. So that's an important distinction from some of our peers. When we look at, on our analysis, when we look at publicly listed royalty and streaming companies, somewhere in the order of 90% are either entirely or majority focused on precious metals. And when we look at the number of existing royalties on some public databases, it's probably about 70% on precious metals. So relatively, we think that's an area that is less well served. There are effectively fewer players chasing relatively more opportunities. In the non-precious space, you can see we are a significant player. We're about a third by market cap by our analysis of players who are chasing non-precious opportunities. And really importantly, we have that significant cash flow we're generating and liquidity that enables us to make further investments. Again, something we see as a really important point of difference from some of our peers. In terms of the investment targets, we're looking to add assets to the portfolio in areas where we think we have a competitive advantage. And for us, that really means from a commodities perspective in bulk. And by bulk, we typically think about that as being iron ore and some of the fertiliser commodities such as potash, as well as base metals like copper, nickel and zinc, and some battery metals. And of the battery metals, the ones we're probably most focused on at this point are lithium and cobalt. We do have a focus on some of the more well-developed mining jurisdictions. I think, like many of our peers, we recognise that as a non-operator, our ability to control political risk is pretty limited. So we focus on Australia, which is our backyard clearly, but also within the Americas and Europe. Our target investment size is sort of in the $100 to $300 million Australian. Again, an important point of difference in that we can write fairly substantial cheques for the right opportunities. We clearly have the flexibility to move above that or I guess very importantly below that for the right opportunities and for good quality investments. We've seen a material uplift in the number of opportunities coming to us in the past months as other competing sources of capital have become less available to counterparties. We are active. We actively look at second-hand opportunities where we see existing royalties being traded, but where we've seen most of the increase in activity is in talking to companies about providing funding for either for project development or in support of M&A activity. There's obviously the funding can be used for balance sheet repair, but that's not as big an issue for the industry at the moment. The $350 million facility we put in place last year remains undrawn and provides us with the liquidity we need to act on these opportunities, and it's an important element of our growth platform in terms of supporting our position as a preferred counterparty. So to wrap up, I know that many of you will be very familiar with the royalty and streaming model, and it's a well-trodden path. It's a business model that's been pursued successfully by many companies. We are looking to pursue that model, but with some important points of differences. It is a simple and transparent business. It's underpinned by a very high-quality cornerstone asset that provides exposure to what we believe is one of the best iron ore operations run by one of the world's best miners in the world's best iron ore province, with very limited exposure to cost and capital, operating capital cost inflation. We also have a strong growth platform, both from the continued ramp-up of the South Flank operation within Mining Area C and from our focus on value accretive further investment. So with that, I'll wrap up and take any questions. Thank you.